Well, folks, it looks like inflation is back on the rise. We're going to take a look at a recent report from Apollo Academy showing that basically from every measure, inflation itself is headed back up yet again. I'm also going to explain why this is happening right now and what it's going to mean for your investing in 2025. First off, we can see here, this is a chart of the 1970s inflation pattern overlaid with where we are at right now from 2014 through today. And you can see while it doesn't line up exactly, the overall pattern is eerily similar, especially considering the fact that the inflation measures today are more muted than they were back in the 70s. Values on the y-axis for today versus the 70s are probably even more similar than this chart shows. But as you can see from the green line, we have been following pretty much to a T the pattern that unfolded during the 70s, which would indicate we have a much larger increase in inflation ahead of us, that the worst is not behind us. If you extend today's inflation pattern following the pattern of the 70s, given the advance from where we are at today, you would expect we would reach an 8 or an even 9% inflation rate by about 2028. Next up, we can see that the Federal Reserve's own measures of inflation stickiness are continuing to stay above their own target of 2%. This black line that goes across at 2% is their own stated target. However, the Atlanta Fed Core Sticky CPI excluding shelter, or the sticky CPI itself, or the New York Fed measure of inflation persistence are all well above their target. Speaking of being above target, we can take a look at core CPI at 3.3%, while headline CPI, not only is it at 2.7%, but you can see there's this little tick up here at the end, indicating that headline CPI has bottomed and is now moving higher. This view is supported by the fact that core CPI is showing signs of re-accelerating when you look at the annualized change over 3 months and 6 months. You can see again, it looks like things have bottomed out and are going to be headed higher from here. We see the exact same picture with core PCE, also showing signs of starting to head higher from here. Super core CPI is showing the exact same picture, as well as super core PCE, corroborating the same view of inflation heading higher from here. And you shouldn't expect to see any reprieve in inflation numbers from housing, given the fact that forward-looking data like signed leases show that housing inflation has bottomed out, meaning we are not likely to see a nationwide average of housing prices moving lower from here. Instead, we are much more likely to see them stay the same or continue to move slowly higher. Data from the University of Michigan shows that people expect prices to change for the worse next year. In other words, people are expecting inflation to continue to rise. Now, this is just the short-term data that we're looking at, but if we switch over to the long-term expectations, we can see an almost identical picture with expectations over the long term being that prices rise. So what is the explanation for this? Why is inflation coming back now? And especially considering the first chart that we looked at, why is it coming back at right around the time we would expect if we're following the same pattern from the 70s? Well, this is something I've been talking about for quite some time now on this channel. We are in the next phase of the long-term debt cycle. The parts of the economic machine that are at play here have been in play before. The debt to GDP ratio at 120%. The pattern of a flood of money printing followed by trying to tighten financial conditions to stop the inflation, followed by easing financial conditions to try and stop a recession or a depression, flip-flopping back and forth, ultimately fueling higher and higher inflation along with stagnation in growth. In other words, stagflation. In other words, what we are seeing play out right now is that there is no way for the government to get themselves out of this sovereign debt crisis without printing. The Federal Reserve is lowering interest rates, but it's resulting in lower interest rates for the government only. This is why mortgage rates and other interest rates that actually directly impact people like you and I are not going down. They're actually still going up, even though the Fed has been lowering rates. In fact, the only rates that you've probably noticed have been going down recently are the interest rates that you're being paid on things like your high yield savings account or your money market fund, which means you're paying more for debt and you're getting paid less on your savings, just adding salt to the wound. The reason for this is because these are indirect funding methods for government borrowing. And as the Fed lowers rates, they use the cash in the system, like from your high yield savings account, in order to indirectly loan money to the US government. So yes, if you are a saver, you are indirectly a lender to the government. This is the long-term debt cycle playing out in front of our eyes. I've told you for a long time to expect higher prices and higher rates, even if the government itself gets to borrow at lower rates, because they print the money to pay their bills, to pay their expenses through lower short-term rates. Because this flips on the money printer through the banking system, it increases the money supply. As this new money comes into circulation, it pushes up prices. As prices go up, the purchasing power of the dollar goes down, and lenders want to be compensated for the loss in their purchasing power. So rates for you and I, where people can actually control their rates, go up. So for the foreseeable future, I'm talking years, not months, expect more of rising prices and rising interest rates. Okay, so what does this mean for your investing in the next year during 2025? Well, number one, it is likely to be a painful year for investors who are following the standard investing advice, modern portfolio theory, the 60-40 portfolio. This is because the standard allocation is going to have a high exposure to long-term bonds. You can see investors in long-term dated government bonds did not do well during the year of 2022, which is a pretty good example of what you could expect going into 2025 if we do in fact see inflation continue to accelerate. You can see TLT had an overall drawdown of about 30% from the start to the finish of 2022. The reason bond funds and bond prices in general do poorly during times of rising rates is because interest rates and bond prices are inversely correlated. If interest rates are headed higher, that means the price of those bonds themselves has to be headed lower. And so holders of long-term bonds, like index funds like TLT, take a bath. 2022 is also a decent year to look at as an example for performance for stocks, where investors in stock index funds like the S&P 500 saw an overall drawdown of about 20% from the start to finish of 2022. The reason that stocks don't do well, at least in the short term, during periods of rapidly rising inflation is because in this specific circumstance, you do end up with tighter financial conditions. Even though the Fed is lowering interest rates for pretty much everything else in the free market go up. The only entity benefiting from those lower rates is usually the government. So tighter financial conditions for the broader economy make it difficult to invest and spend, and that dampens business activity, especially if that is preceded by a crazy bull market in stocks, which when we zoom out and look at what the S&P 500 has done recently, certainly fits the bill. Now, long-term risk assets like S&P 500 index funds are still a way better choice than something like a fixed income fund. For those of you who don't have any other choices because all your money is in a 401k or something like that, you're still going to do much better over the long term investing in the stock funds rather than the bond funds. Bond funds are going to be very hard pressed to have a real return after accounting for the loss of purchasing power from inflation. But if you do have more flexibility with your investing choices, there are a few things you can do to capitalize on what's going to be happening over the next year or two. Personally, I'm increasing my allocation in two key areas: safe haven assets and inflation protected assets. There's going to be some crossover between these categories, but you're going to see things like money market funds, high yield savings accounts, gold, Bitcoin, and cash flowing real estate. Now, you might think increasing allocation to cash sounds ridiculous given the fact that I've just spent this whole video talking about inflation, but I specified money market funds and high yield savings accounts for a reason. It's because they offer a pretty close, if not better than, the inflation rate in terms of the return that they provide you. And they give you an instant access to liquidity so that if there are quick drawdowns in asset prices, you have some dry powder to rely on. And right now, pretty much everybody is very light on cash. Overinvestment from money managers, overinvestment from retail. Very, very few investors are heavy in cash right now, which means that we're likely to see that pendulum swing, swift sell-offs in specific asset prices. And if you have the cash, you can take advantage of it. You don't have to be the one forced into a fire sale because you need the liquidity for something else, or you got pushed out from something like a margin call. So short-term increasing cash allocations in the higher yielding accounts like a money market fund. Don't lock it up in things like CDs or bonds, because then you won't be able to access them if you need them. And then for the longer term stores of value, you're going to look at things like gold and Bitcoin and cash flowing real estate so that you can protect yourself from the erosion of the purchasing power of the dollar. If you would like me to help you apply ideas like this to your investing in a way that is more tailored and step-by-step, go ahead and click on the link in the description below and check out my private program. As always, thank you so much for watching. Have a great day.